would I rather have $1 million at retirement as my emergency fund or a guaranteed 350 for life?
Yeah.
I mean, it puts perspective on an emergency, and then one of the potential negatives with an annuity might be legacy, but that's why life insurance integrated well is your perfect 1-2 punch.
So you wanted me to criticize my own stuff, and I say that the stuff that I get criticized on is people say, well, but then you're spending the money and there won't be money for the kids. Well, the annuity's not there to leave. It drives me crazy when people buy annuities to leave money to their kids. That's not what I'm doing. I'm buying annuities for me. The annuities are for us, my wife and I. The life insurance goes to the kids. Okay. I tell people all the time, you are not supposed to leave your kids any money. You are supposed to spend your money. Leave them life insurance. We bought $1 million second policy for $150,000. That's 15 cents on the dollar. They get $1 million tax free, and plus now I've got 5-6 million of that whole 6-7 million in that whole life. So I mean, there'll be plenty of money. Okay,
Yeah.
for the kids. They don't need my money. They're going to get life insurance. Okay,
Yeah.
that's the most efficient way to do it.
This might be too personal of a question, but what happens if you just have too much money coming in per month? I know, and that sounds like a dumb question. Do you just invest the difference? Do you give it away? And then what does the research show? Or is that like a I'm rich problem and that we don't even need to talk about? I'm just genuinely curious because you do get to a point where I know you're not like a crazy spender.
No.
You're not and I know that you've done the type of planning where you've got to have cash coming in that's pretty impressive each month.
Yeah, well, what the deal is, I'm trying not to save money anymore, honestly, because I mean, why? I'm 65. Why should I be saving any money? Really, seriously, I've got enough money, I think, so I'm just turning it into income. But my wife and I are traveling. I'm super tithing now, so I'm giving 20 instead of 10. To think 10's hard, try 20. So I mean, we are giving money, we're spending money, and I'm walking the walk of everything I've talked
Yeah,
about. I don't
that's
just
great.
talk all these. This is how I'm living. Everything that's in these books is how my life is. Okay, and I use this to build my wealth. So I mean,
Yeah, I
everything I
love it.
read about and speak about is stuff that I've done or am doing right now.
Yeah, I love it, and your golf game will improve as well as your pickleball game. So that's
Hopefully.
you'll have more time to focus on the things that really matter. All right, I'm going to hit you with another question that you may have not have done a ton of research on, but I'm just curious your thoughts. I just interviewed a guy by the name of Tom Gober. The interview just released on my show yesterday. And he is looking at insurance companies and looking at some insurance companies and starting to ring the bell and say, "Hey guys, you're making lifetime promises, and your books don't reflect that." And so he has no problem with annuities. He has no problem with life insurance. He actually loves this space so much. So he's one of these people that aren't just saying these are a scam. He loves them so much where he gets angry is these insurance companies that are making lifetime promises but might not be there to show for that. Have you done much research on that? And do you have a comment on what someone can do to make sure that they are with a company that is rock solid?
Yeah. So I even commented on this. If you look through my posts, and I think I commented on his post, that Larry Rimka has done a lot on this. Carrie Pector has done a lot of research on this. They're the voices that are out there really ringing the bell. Bobby Samuelson, they're ringing the bell. Hey guys, got to be careful. There's private equity companies or insurance companies, and they're investing way different than a AAA mutual invests, and they're offshore and it's Cayman Islands and all this other stuff. So I think it could, if there's a big financial crisis, it could be a huge problem. And it's a reputational problem that would affect the AAAs as well, because if insurance companies start failing, then the entire industry gets a bad name. So, but I say in my books, all insurance companies are not created equal.
Yeah.
Every advisor has to pick their level of what level their risk they're willing to take. Most of my contracts that I own are with AAA mutuals. Not all of them. I have some in the other space. I even have one or two that are probably one of those private equity owned companies. So, I mean, I'm diversified, but I think you need to be careful. And that's another reason why maybe you keep the annuity sales at the 250, 300,000 per contract level so that they still have the state guarantee funds that could help if there was a real bad situation.
Why don't you talk about that? Because that sounds like a pain, but I know that it matters, and like why potentially having some small annuities with multiple carriers could be different than having all of
Yeah.
your money in one thing. You might lose some efficiency, but you might pick up some diversification that could be helpful.
So Dr. Michael Finca and Dr. David Blanchett just kind of did a white paper on this, talking about how people don't know about these state guarantee funds. And part of the reason is you're not really supposed to talk about them with clients, but they are there. It's kind of the insurance industry's FDIC insurance. It's the states guarantee up to a maximum of 250,000 or 300,000 per. I believe it's per contract. Might be per person. I'd have to check that. But you could do one on yourself, one on your spouse, one joint. Those would all three be protected. And I think each contract is protected. We'll have to look that up. But that gives you some additional protection that if the insurance company, and by the way, most annuities have such high reserve requirements that there's going to be money there to go to the people. It's not like all their money's going to be gone. That's
Yes.
not a very likely scenario. But I would say, keep it within those state guarantee funds when you can, and that just gives an extra layer of protection.
Yep. No, I agree. And just to go off of what you're saying, I've talked to people that will do the smaller annuities because per contract they're giving their clients that extra protection, which I think is awesome. Tom, I drilled you with so many questions, and you are a very efficient talker. Anything else that you want to say as we land the plane? It's always an honor to have you on, and I'm just so grateful that I can call you a friend.
I just think that agents and advisors can't be ashamed of insurance and annuities. These are great products that help people, and you just got to get better. Follow Tom Wall if you want to sell whole life. He's a great person to follow for whole life. Follow me for ideas on annuities and guaranteed lifetime income and stuff, and kind of know who the key players are that you can follow that are going to share with you valuable information that will help you in your business and give you the confidence. See, I've got 100% confidence talking to anybody about annuities. I know it in my heart. It's not just in my head. I'll tell you a quick story. So I was in New York just a week or so ago, and I was filming 10 episodes for CNBC on this Moving America Forward series that William Shatner started. Well, I was having breakfast in the morning with a couple other guys, and there's this guy over there who's listening to us talking. We're talking about annuities, and he goes, "Oh, annuities are a scam," and he just started railing on it. And the two guys with me started trying to convince him that he's wrong. I just got up, I walked over, I sat and had breakfast over there by myself because I learned that this guy is not somebody who's even got an open mind, who will even listen to the facts, and a man convinced against his will is of the same opinion still. So you kind of got to know when to hold him and when to fold him. And I'm not going to argue with some guy who knows nothing about nothing and he's just spouting off. That'd be non-productive for me. So if people are really interested in retirement, they want to know the right way to retire, I can help them. Some people think they know it all and they're going to do it. Them fine, let them do it. It's a free world. I can't fix everybody, but I can fix anybody who wants to be fixed.
Yeah, no, like I mentioned earlier, health is really important, and if we can start having the conversation about accumulation versus distribution, and then just simply asking, what helps my legacy? What helps me potentially live longer? What, like, the big risk in retirement is running out of money or that volatility. If you can create something, I could almost make the argument that you could have a greater legacy, because instead of you locking up or having, I think as Curtis Cloak talks about, like, and you probably all take these things from each other, but like all your money being held hostage,
Right.
create 20 or 30% of your money, lock it up, free up 70%. And oh, by the way, what does that look like over the next 30 years or plus, versus having all your money being, quite frankly, inefficient because it's all kind of having to be used? I could make the argument that you'll have a greater legacy by applying insurance products like annuities. You'll live longer. The data is pretty clear about that, but that you also spend more money. So it's like, spend more, live longer, give more away, be willing to change your mind because this happens to be an insurance company that you would have to work with. And if that breaks your brain or your ego, then do it your way and see how it all works out.
Yeah. And, people harp on liquidity, oh, there's no liquidity in that. Liquidity is not a one-time event. Liquidity is a lifetime event. When you add guaranteed lifetime income, you are increasing your lifetime liquidity.